So imagine for a second actually beating Walmart at their own game right now, like getting more
Yeah.
people to walk through the doors than the undisputed king of
Right.
foot traffic. Well, today we are doing a deep dive into exactly how Target just pulled that off. But real quick before we jump into the numbers, a strict disclaimer here.
Yeah, always.
Everything we talk about today is for educational purposes only. We aren't licensed advisors, and this is definitely not financial advice.
Exactly. I mean, our mission today is parsing through Target's Q2 2026 earnings. We're using recent retail scorecards, SEC filings, and AP News reports to really figure out what's real and what's noise.
Right.
And to kick us off, I actually need to eat some crow and correct a claim we made a few weeks ago.
Oh, really? What did we get wrong?
Well, we said Walmart was basically untouchable on traffic,
Yeah.
but in this quarter, Target's foot traffic actually grew by 3.6%.
Wow.
Yeah, that is a massive shift because it outpaced Walmart U.S. traffic, which only saw 1.5% growth.
Honestly, seeing that 3.6% growth just totally blew my mind. I mean, when consumers are feeling the pinch, you'd think they all default to Walmart for the absolute lowest prices.
Oh, right, exactly.
So how exactly did Target flip the script? Are people just suddenly craving higher-end home goods?
It's not exactly. No, they actually pulled off a very strategic merchandising turnaround. They realized they were losing the weekly grocery and
Oh, the everyday stuff?
essentials trip. So they made aggressive price investments, like literally rolling back prices on thousands of everyday items.
Yeah.
It wasn't about selling you a more expensive lamp. It was about driving trip frequency.
Got it.
They want you coming in for milk and eggs, and maybe you grab that lamp on the way out.
Okay, let's unpack this because that makes a lot of sense. Getting people in the door is half the battle, but those aggressive price cuts could easily just cannibalize their margins if they aren't careful.
Right.
Looking at the top line, though, it actually translated to a massive sales beat. Net sales hit $26.54 billion, which is up 5.3%.
Mm-hmm.
Comparable sales growth, meaning sales at stores that have been open for at least a year, hit 3.8%.
Right, and it wasn't just in store. The digital momentum is a huge part of how they
Yeah.
hit those numbers. Digital comparable sales rose 8.7%. And the real standout there is same-day delivery, which grew
Wait, over 25%?
25%. That is wild.
It is.
When you think of a legacy brick-and-mortar retailer, you don't expect them to adapt to e-commerce delivery demands that quickly. It's like turning a massive cargo ship with the agility of a speedboat.
That's exactly it. Using the physical stores as delivery hubs cuts down the last-mile logistics cost.
Right, instead of shipping a toothbrush from a warehouse
Like,
3
yeah.
states over.
Exactly. And it's working so well that they even raised their full-year guidance, noting they now expect net sales growth of around 5%.
Okay, so foot traffic is up, digital logistics are booming, and they're projecting 5% growth. It sounds like a flawless quarter. But I know you've been digging through the SEC filings, so tell me, what's the catch? Well, what's fascinating here is the catch is hiding right at the bottom line. If you look at the headline numbers, their GAAP and adjusted EPS, which is earnings per share, essentially the actual profit they generate for every share of stock, came in at $4.11. That is up roughly 100% from the $2.05 they reported a year ago.
Wait, doubling your profit per share sounds pretty incredible, though.
It does, until you realize it was massively inflated by a one-time macroeconomic windfall. Yeah. They received a $994 million tariff refund from the government. That single retroactive federal refund contributed $1.65 per share to their total earnings.
Okay, hang on. I hear you on the tariff windfall.
Yeah.
Getting almost $1 billion handed back to you definitely makes the math look...
Yeah, very pretty.
But to be fair, even if we subtract that $1.65 from the $4.11, you're still looking at $2.46.
True.
That's still a very real adjusted beat compared to last year's $2.05. The underlying business is objectively stronger.
You are absolutely right. The core operations did improve, but we have to connect this to the broader context of the stock market. Target stock was already up 55 to 59% year to date walking into this.
Ah, I see. So the market had already priced in
Earnings report.
a flawless performance.
Exactly. When expectations are elevated 55 to 59%, investors are looking for perfection.
Right.
So even though it was a solid fundamental beat, relying on a one-time macroeconomic windfall to achieve that massive headline growth makes the valuation look a bit precarious.
Yeah. For anyone listening who tracks the retail sector, it's a good reminder that a headline number rarely tells the whole story.
No, it really does.
So putting the traffic wins against the tariff inflation, I want your definitive analytical verdict. How are we scoring this quarter for Target?
I score the quarter an 8 out of 10. The core traffic and the digital growth metrics are fundamentally strong. Even if the bottom line EPS looks artificially perfect because of that tariff windfall, the actual execution of getting shoppers back in the doors with lower prices and expanding their store as hub delivery volume is
Yeah.
very real.
I can agree with an 8 out of 10.
Yeah.
And I definitely have to revise my earlier take.
Oh, yeah.
Yeah, I severely underestimated Target's ability to win back in-store foot traffic in 2026. I thought they'd be permanently squeezed by Walmart on prices, but the numbers prove they've engineered a real formula to get consumers off the couch.
They certainly did. And it leaves us with a provocative thought to consider moving forward.
What's that?
If a single retroactive tariff refund can so drastically inflate a quarter's profitability for a giant like Target, how might future international trade policies permanently rewrite the competitive hierarchy of American retail?